One of the hardest part in trading is actually making that jump from losing money to becoming profitable. And it can take years, definitely requires a lot of patience. But if you do things right, if you listen to the right advice, I believe you can get there a lot faster. So today we've compiled advice from traders that we've interviewed in the past about what does it take to go from struggling to consistently profitable. You hear a lot of good things in this. It's a 1-hour masterclass. So there's a lot of content. Make sure you watch this and take notes, or watch it while you trade if you want to. Comment below with your favorite advice and we'll dive right in.
Let's start with this thing about becoming a risk taker. When we learn trading, okay, so if I started now, if I'd never traded in my life, I'd probably think it's a puzzle that I need to solve. Okay, I need to find a way to identify opportunities in the market. That would probably be done with analysis, following the market, understanding the narratives, understanding what's driving price, and then finding a system that identifies favourable setups, and then trying to apply that system whilst following the price in the market, and assuming that system without any proof, but probably assuming that system or method or approach generates a return over time. That is what I would imagine I would do, and I sort of did a form of that when I got into the job, and I kept following that sort of pattern. But you don't really understand what the job is, because the job is about you, it's within you. Okay, it's not what you do with the market. There's two elements. What I'm just describing there is the transactional aspects, and we just think about that. I would not be thinking about myself. How do I make myself better? How do I become better at what I do? How do I develop myself so I do those things better? And how do I understand the interconnectivity between who I am, the person doing those things, and the actual doing of those things in the market? So I should imagine that I probably would not be thinking about working on myself. And that was what happened in my own trading. I didn't work on myself. I knew the psychology was important. I actually read books on psychology, and I was always interested in it. But I took an academic interest in it rather than a personal interest in it, rather than thinking it's me who needs the work, but rather than thinking I just need to understand it, and if I do that, then I can work better. And I think this is part of the challenge of doing this job on your own, alone, at home. Everyone thinks it's the transactional elements of the job. I just need to find value. I just need to identify setups. I just need to place them. I just need to follow the market. I just need to follow the news, the data, maybe construct a system, and the results will follow. But we know it's not. It's a performance activity. It's a lot more challenging than that. I talk about these sort of things a lot in the book. And part of the problem with the idea of discipline is discipline is just a symptom. That's all it is. It's a symptom of something that goes much deeper. Okay? It's the part we see. We think, God, I should have done that, right? Should have done that, or why didn't I do more, or why didn't I do that, or etc., etc., etc. The problem is that there's usually a lot going on below the surface, a lot going on deeper. The issues that lead to ill discipline or a lack of discipline are way below the surface. Think of an iceberg analogy. You only see 10% of the iceberg, 90% of the iceberg is below the water. With behaviour, with psychology, we only see the outcomes of what's happening below the surface, and we give them labels. We call them indiscipline. We call it FOMO. We call it impatience. We call it perfectionism. But actually, there's a lack of a true understanding of what's really happening, both within your process, both with the realities of the uncertainty of the market, the realities of how we cope with uncertainty. Misunderstandings in our system or method, where we're using a system or method, or we're taking trades which we shouldn't be. They're not made for us. They're made by somebody else. They fit somebody else. We haven't evolved our own approach, which suits us and aligns with who we are. We might be using too much capital. You know, we might be putting too much money on it. We want to be, you know, for a lot of people, they want their Lamborghini at the end of their first year. They don't want to wait 20 years to get their Lamborghini, you know, which is the reality if they ever get one at all. You know, if they're going to get one, it's probably luck. You know, they probably put on a big trade. You know, they've gone to the casino. For a lot of cheap people who make money quickly, they go to the casino, they make a lot of money. You know, they put on some lucky bets, they work out, and then the Lamborghini goes back, the money disappears, because luck is not a companion to rely on to succeed in this role. That's why, you know, a lot of people are getting into trading early, they get into a wave, they get into something which is fashionable, popular, making money at that point. Quite often that's how people start. You know, when I started trading, I would say my initial interest was because everyone was talking about penny shares, penny stocks. That was the big thing in the mid-1980s. Everyone was talking about it. It was the crypto of its day, or it was the small caps of its day, or it was the Tesla of its day. You know, everyone heard a story of someone who bought a penny stock and, you know, the next year they were a multi-millionaire, and, you know, those stories become legendary. They get passed around in the media, social media these days, but the media in those days. You hear about it from someone else, you know, I want to do that, I want a bit of that. And for a while it works. You know, we saw that in 2020. You know, there was a huge amount of liquidity went into the market because of COVID and the COVID measures, which caused a huge, you know, rally up in many, you know, sort of small cap stocks and in crypto coins as well. You know, we saw the meme stock sort of craze, and you didn't need to be skilled or have any ability to make a lot of money there. You just had to buy it and buy and hold at the time for a while. These crazes have been going back. That's human nature. You know, this has been going back centuries. You know, you got the tulips in Amsterdam in the sort of 17th century, the tulip craze, the South Sea bubble, and they keep happening. And a lot of people make a lot of money jumping on those, and they usually end up getting ruined by those. That is not trading. That's just buying a lottery ticket, jumping on a craze. But it does suck a lot of people in. Most people don't learn to trade. This is my point. They want the instant hit, the instant win. They're not willing to go through that learning process. Whenever you meet really successful traders, they've been through the learning process. They may have got sucked in initially by one of those phases, one of those crazes. They may have initially made a lot of money. Then they saw it all disappear. And then they'll say, okay, that hurt, that was painful, but I've got to find out. I do love this, and I've got to find out how to do it properly. And then they spend quite a few years learning and building up, and indulging in their passion. The greatest thing you could have is a mentor or mentors. Okay, nearly every successful trader I've ever met or I've ever coached, and I do engage in these very in-depth conversations with people, they usually have a mentor. Now, that mentor may not be someone they even know. It could be someone whose book they read or who they followed online. They often have multiple mentors. They may not even be from trading. Okay, but they inspire them and they follow them, and they realise that they can take bits from them. But you need to look at what other people are doing. And there's many great books out there written by successful traders. You know, there's the Market Wizard series of books. There's the books by Mark Douglas. You know, there's books written by great traders like Mark Minervini. You know, if you read that and you decide you want to adopt his style, there's a lot of information there about risk sizing, position sizing, how to do it properly, risk management. You know, so same in the Mark Douglas books. You know, these are people who have done it and made money, and they're telling you about it. Okay, you don't need to adopt their way, because you might find a slightly different way of doing it. There's lots of different styles of trading. There's lots of different categories of trading. You know, if you do go into some way of growing your capital that's successful, you're not doing anything new. You're doing something that's been done before, but you have probably taken bits from other people, things you've learned, things you've read about.
Is there any way to know whether the style you use now is not the right style for you? Like, so maybe someone is like into scalping, but then they realize that style is not good for them. How would they figure this out?
Yeah, well, again, there's a lot of trial and error goes on. You know, some people are great scalpers. They're made for scalping. Their personality style suits that. Other people are not made for it. I run, when I coach people, I run personality psychometric profiles. And whilst I believe anyone can be successful at trading, you have to work in a way which suits your personality and aligns with who you are. There's a certain group of people that I meet that are incredible scalpers. They've got the personality style for it. They're highly intuitive individuals. They're great at pattern recognition. You know, that they almost seem to know what's happening before it happens. They jump on the market, they get in and out. They also respect rules of mismanagement, things such as that. They're not going to put on crazy risks. I had some clients that featured in Jack Schwager's last book, Unknown Market Wizards. And some of them were the most incredible scalpers, but they did an awful lot of work behind it. They weren't just in and out all day long multiple times. They waited for their moments. You probably wouldn't even call them scalpers, but it would be a description of at least one of their style. And they learned from great people. They went through a development program at a prop firm. They honed in their technique, and then they pushed it out. They had failures. They lost money at the beginning. They blew up or nearly blew up several times. They learned from those. They listened to other people, and over time they started to develop a style. Another one who learned at the same time, who was also featured in that book, Market Wizards, started off as a scalping style because that was what they wanted them to do at that prop firm. But he started to go further down the curve, take positions, hold stuff for longer. Still would scalp sometimes, okay, but generally form views on the market, built up risk positions and ran longer term risks in many different markets. So, you know, there's a multitude of different styles. Someone I'm working with who I'm coaching later on today, who's someone who I've worked with for a few years now, incredible prop trader, you know, started out doing this job, spent 3-4 years learning how to do it, didn't really make an awful lot of money, then, you know, started to find a path forwards. And, you know, his first big profitable year, he earned 6 figures. His next big profitable year, he earned 7 figures. His next big profitable year, he actually earned 8 figures. You know, this didn't happen overnight. This is a great example of a story. It didn't happen overnight, and he got mentored by other people. He learnt from others. He built his confidence in himself and his style and his approach. There was a lot of luck because the big 8-figure year and the big 7-figure year were 2021 and 2022, insane years in the markets. There was stuff going on everywhere. There was incredible volatility, and it just worked for him. You know, the subsequent year wasn't so great because that level of volatility which he needs for his style wasn't there. It didn't mean he became a bad trader. Sometimes you need the markets to work for you to suit your style. So you can be an amazing trader and not even make any money in a year because the markets are not working for your style. This is one of the things that people also need to learn about this job. It's not a job where you're always going to generate an income. You're going to generate incomes when the conditions are right, but you also have to be a good trader, means surviving when it's not right, not giving back your profits, you know, sort of staying above headwater. A lot of people think trading's just about making money. It's not, it's also about survival. That's why the risk management part is so important.
If you're in that sort of valley of despair, and maybe it wasn't, you know, the same as my situation, but maybe it is. You know, I've written about this too, in the sense of like spousal risk or things or family risk, where one of the biggest reasons traders drop out is because there's somebody else saying either you can't do it or, you know, honey, you got 3 months to make yourself successful. And, you know, so it's real. So, but understand that, use the support team as you can, but surround people in your life who will put inspiration and motivation into your life. It could be a trader, but I prefer ones that just gonna inspire you. Someone in the morning, you wake up and you get a text call like, "Good morning, Michael," like, you know, from a friend or something, like just called to say hi. Like, these are little things that get the tone going and allow you to live this, again, life of abundance, which is like, again, it's not about wealth, it's about feeling that there's purpose and need. But for the people who are struggling there, and maybe it was a similar situation as mine, understand that, and I'm going to say this boldly, and I know it's going to maybe affect some people. Do whatever you can to make sure you're successful, and anybody who doesn't want to support you in that, push them aside. They can maybe be a part of your life, but don't let them get in your way, because you are a bull running towards a goal. And if you have the passion to do it, nobody or anything should get in your way. And that sometimes at the end allows you to have to make tough decisions. But how strong is your goal? Mine was, I am not giving up this goal. Nobody's getting in my way. And I probably have hurt some people along the way. But now I'm in a position where I've achieved a lot. Maybe now is where I can start giving back, the opportunity to make the world a better place. Maybe enrich other people's lives going through that. So it's a long-winded answer, but don't let anything get in your way. Make a decision now to not let anything get in your way. When I first started out, well, maybe 5 years in, I was with a friend and we were just going over, I was showing how to trade and stuff. And I wasn't really taking it seriously, and I was just showing how to use the platform. And I didn't realize till the end of the day that I was in real live account and not in sim. And it was the biggest losing day of my career. And it was a big one. And I went, oh my God, you know, I can't believe it just happened. I realized it like a few minutes before the close, and I go, why is this number moving? And so it's a stupid thing. I have a little laugh now, but it was really gut-wrenching. So that was where I was on. But really, a lot of times, the worst trades are the ones where you ignore risk management. Because you can have the worst trade in the world, the worst direction. You buy something, and then 2 seconds later, an earnings report comes out. That may be like stupid, but if you have solid risk management and good stops, it's not going to cost you much. But when you ignore risk management, which is what I've been preaching for 20-something years now, when you just don't ignore the risk management side, because even the worst of mistakes, you'll still hang in there. You'll still be able to trade the next day.
Do you know how much money you lost that day, by the way?
At the time, well, it was over 5 figures. And at the time, it was more than, well, it was 5 figures, but it wasn't 10,000. But I remember it was like gut-wrenching in proportion. Now it still would be, like I would be mad at myself. But back then was, you know, it was a lot. And I just shook my head and said, you know, how could I let this happen? I just didn't even, but again, risk controls, know your platforms, just basic stuff. You know, and let's face it, 90%, there's a 50% chance I could have had a winning day that day and not realize it. But let's face it, when you make those mistakes, 90% of the trades, like just to go again. The market just wants to pound you and stuff. Another story I never told. Why am I opening up my heart to you? I did never tell these stories, but that was, again, follow your risk controls. You know when you have that gut feeling you have a bad day? All traders know this, right? You have that feeling you just can't describe and it won't go away. That was painful that week. And the one takeaway is understanding that risk management is a much bigger scope. It's a holistic approach about managing a business. It's not to do with stops. But really, I think the first step is accepting the fact that you cannot do this business without it. You may not even know all the intricacies. We'll teach you that, and you know, there's writings about it. But understand that I don't know what this risk management thing is, but it's a requirement, right? It's like a surgeon saying, I don't know how to do my surgery yet, but I know I need these tools. And once you do that, now is a question of applying. But when you totally ignore it, like I don't need to worry about that, you know, see it in the valley of death of traders. That's where you're going. It's just a matter of time. So looking at, you know, your business, where are you as a trader and where you want to go? So there's a question of, okay, what are the things that are going to get in my way to be successful? Well, I could just give you an example. I learned the hard way. Learning your platform, right? Learning things like that. Well, so learning not to make the same mistakes or lessening the chance of a mistake happening is a great example of risk management, enterprise risk management. It's putting the odds in your favor that your business will succeed, not just a stupid trade of like 250. Who cares? You get stopped out. It's about managing. What are the mistakes I'm going to make, or what are the controls I have in place? Here's a practical example: is, you know, you could have on a broker platform, and we tell your broker, I don't want to lose more than $1,000 a day, okay, just a round number. Well, I don't want to do that. Say, you know what? A good risk control is I'm going to tell my broker to shut my platform off after it hits 1,000. That's it. That's little things where I know I will never have a bad day in the sense where I go rogue, because my rogue day is going to be $1,000. Right. Now, it may upset me sometimes, but okay, I just eliminated one of the biggest causes, risk of ruin, the biggest cause of a trader's demise. Okay, guess what? That's what risk management's all about, not about styles.
First of all, it can be done. I'm one of the people that has been doing it for a number of years. It requires a tremendous amount of work. Again, I'm stating the obvious, but I will get into some of the real, what I would consider good insights from somebody who's done it for a while. I've had my share of ups, I've had my share of downs. It's not an easy business. The key thing, in my opinion, and I think most professional traders would hear me out here or see it this way, less is more. If you're going to try to trade every instrument that happens to come across your screen or that you see on social media, it's going to make it really hard. You have to specialize. If you go to most hedge funds or any of the prop trading desks that are out there at the banks, or any of the prop desks at the hedge funds, because they all have little pods of traders within the hedge funds trying to generate returns, everybody's got a specialty. One person may trade British pound, one person may trade Nvidia, they're very specialized. And if you're going to trade in any instrument, know that you're competing against somebody who's specialized in that instrument. And they're going to have more insights than you because they're doing it, 5 days a week, 6 to 7 hours a day. So for you to show up and go, I'm going to trade Nvidia today. Okay, maybe you'll do fine. But that nuance of not being in sync with how an instrument trades, I think can be really a major blow. So it really requires you to have your blinders on. Doesn't matter what Nvidia did today or Bitcoin or whatever. If you don't trade it, it's just noise, and you should discount the fact that you could have gone over there and traded it well. Maybe you could have, but just do yourself a favor. Stick to what you trade, pick a handful of instruments to trade, and trade them. The other thing you have to get really clear on is you got to trade on a time frame that's consistent with what your demeanor is, your risk tolerance, your demeanor. I know for me personally, I knew this a long time ago. There was no ambiguity about this. I didn't want to be someone who held positions for weeks and months. Doesn't suit my personality. I knew I wanted kind of that instant gratification, short-term bursts. I wanted to capture that stuff. So unless you're trading in a style that is consistent with who you are from a personality and risk tolerance standpoint, it'll never work. The two have to be in concert with one another. So I know for me, anything I try to push past a few days or a week or two in terms of FX or let's say 10-year notes, I know that I'm out of my element. That's not where I want to trade. That's too long for me to wait to know if I've been right or not. So that's really important. If you can find someone who's been successful to kind of take you under their wing, and I know that's kind of hard. Nobody that's really successful is going to want to take you under their wing per se. But if you can get a few minutes of their advice and get some insights from them, that can go a long way. There's so much free information out there now on social media. It's a blessing and a curse, and I would probably say it's more of a curse because you don't know what's really good. You don't know if what that person is doing or what they're saying is relevant. But again, it goes back to maybe point number one. Only focus on a few instruments. Then maybe find a few people who trade those instruments and appear to trade them well. Their commentary makes sense. Maybe pay attention to that. But I think at the end of the day, you got to find your own way. You got to find a trading methodology that works for you, and then you just got to grind it out until you get it figured out. The problem a lot of people have is when they have a few bad days in a row, they get discouraged and like, well, maybe I'll go try to trade this way. Ooh, big mistake. Being wrong is part of it. Being wrong is part of being in this business, and if you can't handle that, think about that for a while, because by jumping to another style or another set of instruments to trade, you're only going to find that might work for a few days and you're going to hit a little bit of a lull again and you're back to square one. Specialize. For me personally, I like trading the big markets because the liquidity's there and the action is there. You're going to get plenty of give and take during the day to allow you to capture a range. I think when you start to get into the lesser known stocks, you know, if you're intraday trading, that is, you're not going to get those moves. You're going to have to be in your trades longer. And that, again, that maybe that's better suited to you, and that's fine. But I'm talking more from an intraday perspective. The bigger the market, the more liquid and the more range it is, that's where I want to be. I also know it's going to be super competitive. You're going against, you know, thousands of traders, algorithmic traders, big hedge fund traders, big bank traders. But you know what? If you sit there long enough, you'll figure it out. And if you use objective analysis to alert you to where the trades are, eventually you'll come around and you'll figure it out. But it takes a long time. There's no shortcut by any stretch. That's a very cliche way to end my answer, but it's absolutely true. I still believe that experience and discretion plays a huge part. But before you can become discretionary, you kind of have to earn it. You've got to show that you can make money as a trader. Even if it's not pretty, you know, even if you're making just a few bucks, if you're demonstrating some consistency and your underlying trade metrics are improving by just using some very blunt entry levels, using these price levels, then you can start to factor in discretion over time. There's a great quote out there. I don't know who it's attributed to, but you have to earn your right to be discretionary. I think to be discretionary with limited experience, that's a no-go, because it's like kind of me. It's kind of like me showing up in an operating room going, I'm going to use a little bit of discretion here on this open heart surgery. I may have read the manuals, may understand it intuitively, but for me to go in and use discretion without having done any operations before, probably not going to work out so well. And I would use that same exact logic in the market. Until you really understand the nuances of how the markets work on a day-to-day basis in the securities you're trading, I don't think your discretion's worth anything. In fact, I think it will actually do more harm. So I think you have to, for me, I got many, many years under my belt. Yes, I want to start with an objective piece of data to alert me to where a trade setup is, but then I want to rely on my discretion and my intuition and my experience to maybe help me fine-tune whether or not I'm even going to use that price level on this instance. There'll be days where prices will come up to these levels and I'll do nothing because the market's not trading in a way that's conducive to that. And as a newer trader, you don't have that insight at that point in time in your career to really make that call. So you have to kind of start off using it very blunt. Okay, we're hitting a resistance level, market's a little overbought, some of these other markets are rolling over, I'll get short. That's perfectly fine. That's how you kind of earn your stripes. You earn that experience. You have to be blunt initially. So I think that answers your question. Hopefully I did a good job of addressing it because I think it's a fantastic question. You got to leave the discretion and the intuition outside of the equation until you've got enough hours under your belt. I mean, old habits die hard. And, as someone who's been at this a long time, I definitely still have some bad habits. And you try to unlearn those habits as you learn new things, but it's very hard. But in terms of the discretion and the experience, I think once you get that under your belt, I think that's not something that you unlearn necessarily, because I think that's a level of experience that you've filtered over the years. I think the bad habits come from doing things because you didn't know any better. Then once you learn that there's a better way, that's an easy habit to break. But I don't think that level of discretion, unless you're not paying attention or you're deluding yourself, I don't think that level of discretion needs to be unlearned, because that's just like millions of data points in your head that I think if you've approached the market in the right way over the years, that will prove to be quite useful for you. So I don't think that in and of itself is a bad habit. I think it's the bad habits you did because you didn't know any better. Those need to be unlearned, and we all have them. That's why you'll never arrive as a trader in terms of figuring it out or have it figured out. Anytime I hear somebody say, I got it figured out, I'm like, whew, oh boy, you're about to be in for a rough ride, because the market's always evolved slightly. And we're always on that ongoing journey as a trader. That's just the nature of it. I am a diligent journaler. I'm also a diligent uploader of my trades into TraderSync software. I know every trade that I have. I've got everything very clearly defined in terms of what type of a setup it was. So I learned very quickly over time what's working, what's not working. And that may not be, let's say, a bad habit to unlearn. That may just be like, that setup doesn't work anymore. Quit trying to make it work. So you have to journal. There's something about writing it down on a piece of paper each day that creates something very connecting for me, and I've heard it from many other traders. I journal every trade that I do. I don't do a lot of trades during the day. I might do 4, 5, or 6. Sometimes, like today, I did 2. If you can't journal those trades in kind of semi-real time, you really should, because you'll get a lot of insights from that. But the key stuff really comes from having those trades uploaded and then being able to look at your trading history, based on time during the day, maybe from 7 to 8 a.m. I'm here on the west coast of the U.S. How do I trade during 7 to 8? What symbols do I trade well? What type of setups are working for me? It's like any other business. You have to go back and you have to see what's working, what's not working. How do I make adjustments? So yeah, unless you have that data and if you're not keeping track of that data, you're missing out on something that's going to really keep you continuously keeping your edge.
It was quite a highly paid job, so I'd left that money behind and thought, trading's everything for me. So I quit my job, started trading, couldn't make any money for 3 months. And it was psychological. It was all psychological. So it wasn't that I was not pushing a button on trades. It was, I was probably not sticking to my rules, whereas I take money early because I needed the money suddenly. Mortgage to pay. So yeah, I was just stuck in a bit of a rut there for 3 months where I wasn't losing money, but I wasn't making any money. And it was a couple of months before Christmas, and I thought, oh shit, I've really, really got to do something here. I do this or I don't. I go and get a job, and there was no way I was getting another job. I did stick to my rules. I thought today I'm going to stick to my rules. So it was one day at a time. Today I'm going to stick to my rules. If I press the button, I'm not allowed to do anything. So what I was doing is pressing the button, and so I didn't fiddle with a trade. I go and look at a different market, and then I place a trade on the next market. Turn it off. I wasn't allowed to look at those 2 markets. I'd actually put, stop losses in and limit orders, so I'd take profit at 2 to 1. That day I made money, so I did the same the next day, and then the next day, and it was a day at a time, and then a week at a time, and then did okay up to Christmas. We had a great Christmas. And then from January, I kept doing the same and just building on it. I got back to the way I was trading when I had a job, because then suddenly I could see the money coming in and I could see, yes, this is working. I had worked on myself a lot with my psychology. I think my psychology for me is probably 95% of trading. I think seeing a strategy, anyone can get a strategy, a working strategy. Psychology has got to be 95% of this. It has to be.
Was it the fact that you didn't have any other income, so you had to make it work with trading, or was it something else that kind of forced you to make more mistakes?
I think I made a lot of my mistakes early on, and I learned from them quickly. But when I was really struggling when I gave up my job, because of course I gave up my job, there's no money coming in each month, and it is shit or bust. It is. I either make this work or I don't. I go and get a job. So literally, I didn't want to say to myself, right, I've got a job because I didn't stick to my rules. So when I stepped to my rules, I started making money. So I could see that. So psychologically, realistically, that's what the bit I had to work on. So I did. I read lots of books, lots of things on YouTube, and as we all do, suddenly I got my thinking right. I got my thinking straight. I started making money. And then I didn't look back. But keeping it simple for me is quite honestly everything in this game. You keep it simple. You don't overthink things. If you're able to press the button, doesn't matter what you risk. If your risk's £1 or £100 or £1,000, doesn't matter. It's the same trade. It's exactly the same trade. So yeah, when I worked out that I could make money, it was probably over Christmas. And then from the January on, I just really focused on me, not the way I was trading, just focus on me.
Number one thing is, guys, that you have to love trading. Like, I was playing video games when I was a kid. Like, I love these movements and you have to press right at the same time. You know, you have to love it. I had a lot of people read my book and community, and they say, it's too much work for a couple of $100. And they were doctors or lawyers and stuff. That makes sense. They just don't enjoy doing that. It's not for everybody. You have to love this concept of video game, which is essentially a video game. So you have to love the nature of this pattern recognition, because, you know, it's like a quiz every single day. So that's the number one. And the second is you have to have a really desire to go through this learning curve, because you're putting yourself through a very difficult thing. I really love the lifestyle, climbing every day and traveling the world the way that I want. People travel the world when they are retired and cruise and stuff, but I want to travel the world when I'm young and the way that I want, like climbing and stuff. So I really love the lifestyle, and that's kept me going on. And people can have different reasons, like for family or for retirement or whatever reason it is. You just have to find your things that drives you, and then just always put that as the head, as your, the reference to try to push toward that.
Do you think desire is enough to succeed in trading, or do you need like any other sort of traits or mindset?
No, I don't think it's, it's definitely a necessity, but it's not enough. If you really want it and you cannot do it, then maybe you should stop, because that's the definition of insanity. You just keep doing something that doesn't work and then repeating it. So desire is very important, but you have to see out all other elements. Do you have time for it? Do you have the time zone for it? Do you have the patience for it? Do you have, a lot of people, like, their family situation may not allow them to trade. Like, I was young, blew up $2 million, and, I could survive, but a lot of people can't recover from that kind of losses. So that's one element. Luck is also, I think, is a very important element, especially at the beginning when you get some early beginner's luck and make good money, so it sort of gives you a cushion. But in the long term, the consistency doesn't come with luck. So there are so many elements in that. And it's okay if you try trading for some time and, you move on. There's nothing wrong with this, because it's business, entrepreneurship. You start a business, doesn't work, and then you move on to another one. The things that you learn during the process about yourself, I think it is valuable in the next challenge of life. Like, I was lucky that I'm in the Pacific time zone in Vancouver. The market opens at 6:30. I told you that I was unemployed, and then I had to get a job because I was losing all the money. So, and I could trade 6:30 to 8, and then 8 to 9, I get to my job. 9 o'clock, I was starting my job. So I was lucky. If I was in the East Coast, I couldn't do it. So depending on your situation, for example, if you want to day trade US stock market, you have to be available 9 o'clock to 11 in the Eastern time zone and New York time zone. If you're not, then forget about it. Because how can you do that? Some people, like, there was a delivery guy said, I'm doing delivery, I was just starting, pulling over and try to trade. That doesn't work. You got to be available for that. Some people in the office, but it's not sustainable. Maybe you go to Forex trading, because Forex is more like a longer time frame, and it's a different thing. What I love about the US stock market is opens and closes at the same time. So your day is very structured. Crypto, open 24 hours. You don't know where the volatility comes. You're sleeping in China, something goes up, and it just, I don't like that. I like the structure of day trading. Everything is in the first 2 hours. If you missed it, forget about it next day. I think trading in a simulator is very important. Like, do not jump into any trading yet, just trade in a simulator. Because if you're consistent in a simulator, then you move to a real account, then there is no guarantee in the success in a real account. But even if you fail in a simulator, then forget about it. Why would you want to go into the live account when there's all psychological element? Trade in a simulator, that's what I would say.
Did you trade in simulator?
No, I didn't. That's what I'm saying. I lost so much money. Like, the first trading that I did, I started trading, like, it was like a Bank of Montreal, which is a normal retail bank. It's not broker. Like, I orders $10 per ticket commission, and then you have to confirm your phone number. Are you sure you want to buy that? Like, and I was trading pennies with that. Like, I had no idea what the hell I was doing, and no simulation. And after, obviously, then you get having these losses, and you start thinking, okay, I gotta do something. I'm doing something wrong. And then I started looking around more for simulators and trading in the simulator. Yeah, for 3 months, I think I traded only in simulator. The best trade in terms of profit or in terms of execution? I don't see the best trades. Oh, I made like $50,000 on this trade, because sometimes luck is part of it. You take too much of a big size and you get lucky. But The days that I stick to my rules and patterns and entries and exits are really perfect, those are the say I'm really happy with that. But the days that, like for example, today Tesla, I traded 4 or 5 times and very heavy losses at the beginning and eventually made that back. So it was a day that was a struggle. You kind of, it was hard to, manage your positions and your emotions. And those are the days that I gave myself, even if I make money, is a dislike. So for me, a good trading day is 1 or 2 trades, perfect execution, perfect trade management. And I would call this is a really good trade, no matter how much money I make. Even if it's 1 trade and I get it stopped out properly, and that's it, I think it still is a good day because I stick to my rules. You just have to keep it as, it's a work in progress. Don't set up a goal for yourself because you set yourself for failure. Just keep pushing and keep going and keep it on the side. I'm a big advocate of part-time trading. I know you trade full-time and travel the world and stuff, but that's not everyone have this luxury. So, trading part-time is very important. Keep your career, keep your business, keep your passion, and just try to make a little bit of money on the side until you're ready. Like I had the job until 2019. I still had the job and I was making good money from everything, but I still had the job 2019. Then that's where I quit.
My view is that we need mind, money, and method. We need the multiplication sign in between each of those things. So we need a strategy, we need a mindset, we need a money management, our risk management. You can't do one without the other. They all 3 are absolutely necessary. So on a strategy, you got to know you have a positive expectancy, whether you do it by back testing or forward testing or whatever. You need to have some sign that that strategy actually works. And a lot of people take strategies, they create strategies of their own, and they have no idea whether or not it's got a positive expectancy. So they need to either back test it or forward test it, whatever it is, to know that they've got a certain amount of positive expectancy. Then they need to have their mindset. They need to be able to execute those rules consistently. And finally, of course, they've got to have their risk management, their money management rules in place as well. So those 3 things come together. I don't think it's a question of which comes first. I think they all have to be there, unfortunately. And that's what makes trading difficult.
How does a trader know what exactly to work on? Because sometimes they could confuse strategy for mindset or mindset for strategy.
I think this is where your process and your journals come in, right? So if you have a strategy that says, okay, I'm going to analyze the market, I'm going to go with the trend, I'm going to identify the trend, I'm going to go with it, and these are the strategies I'm going to use in an uptrend, these are the strategies I'm going to use in a downtrend, these are the strategies I'm going to use in a sideways trend, and they're very clear about the rules relating to that strategy. So by looking at their journal, they'll be able to tell whether or not they've been executing the rules. It's as simple as that, right? And the same with the money management, which is the same thing as your method in terms of setting out the rules clearly. So for your position sizing, I will not risk more than X%, whatever it might be. So when it comes down to looking at your journal, you can look at your journal and look at your equity journal, look at psych journal and say, yeah, I can see where I did wrong. In this case, I actually should have waited for the market to come into my zone, but I didn't do that. I took it early because I thought it wasn't going to come down. Or I should have waited for my entry trigger and I didn't wait, whatever it might be. The next question, I think, is the critical one, which is I don't have an answer to, and I think maybe Russell Kennedy might. Why don't we keep journals? I mean, this is the
tough questions. Yeah.
Yeah. It's like I always tell my students, guys, look, take a trade, put it into your equity journal, and you should be preparing it before the trade. You should have your psych journal done. Take the trade, put it into your journal. That, to me, is the most difficult part. And again, this is where Russell Kennedy's coming. Somehow, when we relieve the pain, it's as if keeping a journal relieves the pain. And as one guy said to me, what if I keep a journal? I do everything you tell me, and I still don't succeed. What kind of dummy does that make me? I said, look, think of it the other way around. Keep the journal, and you may not be a dummy, right? See what happens. But that I think is the key question. Do you keep a journal? If you don't keep journals, then you're really you're going to find it very difficult to succeed, because journals, I think, are the foundation of improvement and success.
The biggest challenge I see is people are taking in too many different sources of information. That's hard. YouTube is a blessing and a curse. There's great information out there. What you're doing on your podcast, there's other great stuff out there. But you have to almost categorize what it is you are doing. So I always say to swing traders, very often it's less is more. There's a tendency that if something is not working out or you're going through a drawdown period, try and add or change things too quickly. So I would say the three things I get my guys to do is get consistent at your overall market analysis. So if you're trading one market as a day trader, get consistent at how you do that and the time you allocate to it. If you're one of our swing traders and you're looking at, say, 30 markets and you're drilling down to, pulling out 4 or 5 that meet a certain condition, practice that skill. So only think, right, I've got to get good at that skill. Then there's trade execution and getting skillful at the pattern recognition of whatever your entry or strategy is. So, for example, at the moment, I've got probably 5 or 6 possible markets. I'm flat at the moment, but I've got 5 or 6 possible trades. So I'm uber clear on what I need to do in that 10 or 15 minutes in the morning, in the evening, in terms of placing the trade. And then lastly, just get into the habit of journaling and collecting data. If you did those 3 things, and somebody listening might go, well, I don't really clear on my strategy. Well, okay, so you need to get clear on what your strategy is by testing it and being happy with that. But I would say they're the 3 things that I get my guys is get good at your analysis. That's your craft. So you can look at any market and determine whether it fits the particular type of condition that you trade in. Then get good at actually physically placing the trade and reordering your possible trade list and honing in on when you need to place the order. And then get good at data collection, i.e. filling in your whatever form of trade spreadsheet you use to track your trades and your journaling. From there, you've only got 3 things you need to think about. If you've got more than 3 things to think about or focus on, then it becomes less easy, becomes much harder to be effective at any of them because you're spreading yourself too thin. So that's a good way of checking in is, am I trying to focus on more than 3 things? And I'm only going to do one thing at once, but I only really want 3 skills at maximum that I'm focusing on as a whole. And then I'm like, right, okay, those 3 things are going to take time and application to get better at. And then I review each one on its own, and then I review all of them as a whole. And it's understanding you as a trader. I think there is a fine balance between overcoming adversity and saying, right, I'm going to focus primarily on breakouts. And let's say, for example, so for me, breakout patterns, I don't like. I don't trade them. I don't want to. Yeah, I work with people that feel the need that even though they're not succeeding at a breakout pattern within their whole framework, they feel they've got to get good at it. And I'm like, you don't need to get good at it. There are other ways that you can trade within a market. And your stats are showing that you're actually better at this. So it's a fine line between overcoming adversity and trading something that you're struggling with versus just going, oh, well, I'm no good at that and walking away. It's a fine line between putting in the work, but realizing the whole sunk cost fallacy is that, well, I've spent all this time learning about this particular model or method. I've got to keep going with it. Now, that doesn't tend to be the problem I face because of the amount of information that's out there. People tend to, if there was one problem I think I see is they're chopping and changing, but also on the other end of the scale, there are some people that will try something and it's not working for them. And actually they do need to make a shift, and not everybody's the same. People trade in different ways. And I think there's so much out there, and it's also an understanding yourself as well. If I go back 6 or 7 years, one of the biggest challenges when I was coaching people was that a lot of people wouldn't do any back testing. And they would go, well, you've got all the data for the strategies I'm going to trade, Ali. Why would I go and trade them? Fair enough. So that's one extreme. But I think what I've realized now is that actually going out and physically live trading the strategy straight away, I actually think is good. Now, there's a caveat to your listeners here. If that's on a demo account, great. But I think you want to go out with the full stake that you're planning on trading, because you haven't got the experience, you've not necessarily got the data. But going away and trading straight away, what I found is there are certain things that come up when you're in the mix, whether it's the way you analyze the market, the way you trade the market, that you simply don't get from testing. Excuse me. And I think, and also you're more motivated. So I've seen this with traders is they go through, got a strategy, they like the look at it, they've tested it on 2 or 3 markets. I'm like, right, go live with it, even if it's a demo account, go live with it now. And then when it's gone through a drawdown, they're actually more motivated to go and back test because they want to know whether or not that drawdown is typical or normal. So yeah, I'm very big at getting live with the strategy as soon as you can. You're not taking your $10,000 that you've allocated to trade with and risking full stake. Go in with a demo. It's not to create the illusion of you making money. It's that so that you can experience what it's like, test that theory real time. But the premise is that you're building the data in the background. So I think the best is a combination of the two. I'm working with a gentleman at the moment now, and he's doing exactly that. And he said for about a year, he was intending to do back testing and getting 5 or 6 back tests done a week. Now that he's gone out live with the strategy, because he's got 2 markets tested, he now wants to know what the other markets would offer and wants to know what the whole experience is because he's now demo trading it real. And I've got a couple of guys that are trading on very minimal stakes on strategy. So I think a combination of the two works really well. And I do that now. I've got a new idea and I'm actually demo trading that new idea. You could paper trade it, but being in with that concept real time is very different than scrolling back or using auto scroll. It's something, your brain does something different when you're doing it there and then. One of the big things that I'm really doing with traders at the moment is getting them to really own what it is they do, which is a little bit on the lines of what we've talked about. We could talk about trading for hours, but we might not actually, and I have this with other traders I know, we might not actually get into the detail of how the actual nitty gritty of how I trade versus how you trade. Because if you own your trading process and your trading strategy, you're less concerned about what the trader next to you is doing. So yes, you can learn and you can maybe go into that detail and pick little bits up. But one of the things I'm saying to my guys is get to the point where you really feel that you own what it is you do. So you have the combination of live trading data, live trading track record gives you that live trading data. You have back tested data. You are confident in that strategy. You are happy when that strategy goes through a losing period. And I say you're not joyful, but you're okay. You're not happy and excited, but you're like, yep, this is part of what this strategy does. And then you don't get overly excited when the strategy is going through a big winning period. So you're able to balance that pendulum and measure those elements of ownership. So I don't need anybody else's trading strategy. I'm comfortable with the way I trade. Now there'll be a period when I'm losing and another trader's winning, and you might go, "Oh, it'd be nice to be up at the moment," or vice versa. You'll be up and they'll be going through a drawdown period. But for me, that's a thing I'm really pushing because there's so many great things out there at the moment in terms of information. You've got all the funded accounts, but I say to traders, really, really make sure you own what you're doing. You're not being driven to try and make 10% in 1 month, and you've got no trading experience. You're really honing in on what your strategy and what your process is. I think that's a big thing, especially with, as we've discussed, with all the information that's out there. There isn't one way to do it, but I do think if you can hone your way to do it long term, that's gonna help.
I think they need to, find a strategy that makes sense to them, and if it helps them make money, refine it to their personality and their time frame, and have 1 or 2 bread and butter type of, strategies that that you perform well at and can kind of consistently go back to, but always be trying to, try new things. But when you try new things, look at them with, much smaller share size and recognize you're outside of your normal, you're outside your wheelhouse, as they say, and that, it's time to go slower here and recognize there's greater risk because you're in uncharted territory. This is new to you. So go slow. Don't be in a hurry. For me, it comes down to, when people look at my charts, they say, well, what do you look at? And I said, price, volume, and time. Those are the 3 most important. So only price pays. Volume tells us the emotional intensity, commitment. Time is subjective, but it comes down to those three things. So the only thing on my charts is those plus some simple moving averages and anchored VWAPs. I've looked at all the other pieces, the stochastics, RSI, Adams pitchfork, sunspots, you name it. And I, always be curious and willing to learn, but keep it simple. There's a phrase, I forgot who said it, but simplicity is the market's greatest disguise. That, it's just like losing weight. How do you do it? Well, you're more active and you eat less. But, people can still, sell billions of dollars worth of this new program to help you with it. Each year, there's a new fad diet that is willing to be sold because people want shortcuts. And the shortcuts aren't, how you do it. You do it by keeping things simple and focusing on what matters. The thing that matters most is price. That's why I always say only price pays. Because at the end of the day, you can come up with 100 reasons why you thought the stock was a good buy. If the market doesn't agree, then your opinion just does not matter. It's difficult because there's so much information available. And there's so many people passing themselves off as experts. And there's some great young people out there who've done a lot of good learning about the market, and they have 2 to 3 years of experience. And I see them getting, hundreds of thousands of people following them on Twitter. And I look at it and say, these people are book smart about this, and that's a great start. But you need some trading experience and to really get in there and understand the nuances of what's going on in the market. So to me, it's, it takes time. It's about finding your personality again in the market, your time frame. I'm most comfortable with the shorter term time frame. I call my shorter term time frame, anywhere from a couple days to a couple weeks, ideally. That's where I am at my stage in life. My real active day trading days are behind me. It doesn't mean I don't do some once in a while, because I still have that skill set, but it's just not in my personality anymore to really be interested in sitting down and battling it out every day for 20 cents here, 30 cents there. Especially if you're trading on your own, that you don't have someone there pushing you. So you sounds like you speak highly of SMB, and I think very highly of them as well. They help recognize the talent, and they'll push you, buy more, get involved, go heavier. You're there, have confidence in your trade and that sort of thing. It's easy to become complacent in where you are, just doing it by yourself. So I think everyone should, could benefit from a performance coach or someone outside of yourself to say, to look objectively at some of the blind spots that you might see to yourself and say, hey, well, why did you get involved in that trade? And it doesn't even have to be someone who has a lot of trading experience, just someone who's a good performance coach. It could be, someone who's, been trading athletes and that sort of thing, but has a good mind for performance and breaking through to new levels. That's, outside resources are the best way to do that.
All right, guys, I hope you liked it. Hope you got some value out of this. As always, comment below with your favorite advice. I want to hear which one stuck the most, which one you will apply from now on, and which one will make a difference on your trading. If you want to see more of these one-hour masterclass videos, we have a playlist link down below, so you can check it out. Click that playlist. It will be all the videos we've done so far. I believe we might have 6 or more. We'll keep adding more in the future as we go forward. And we'll catch you back here in the next video pretty soon. Ciao.